Before we dive in, please remember that I am not a licensed financial advisor or insurance agent. This presentation is for informational and educational purposes only. The information provided is not intended as financial, legal, or insurance advice. Always consult with a qualified professional before making any decisions about your car insurance coverage. Your financial situation is unique, and the information in this video may not be appropriate for your specific circumstances. It was 2 a.m. on a rain-slick stretch of I-95. The world was a blur of flashing red and blue lights in my rearview mirror. My car, or what was left of it, was crumpled against the guardrail. My hands were shaking, my heart was pounding a hole through my chest, and the first clear thought that cut through the adrenaline wasn't, "Am I okay?" It was, "Is my insurance company going to destroy my life over this?" If you've ever felt that cold dread, that knot in your stomach when you think about your insurance policy, you know the truth. Choosing car insurance isn't just about saving a few bucks. It's about buying a promise that on the worst day of your life, someone will have your back. But how do you know if that promise is solid gold or just cheap plastic? That's the question we are going to answer today. We're going to cut through the noise, the confusing jargon, and the endless commercials with talking animals and catchy jingles. This video is your roadmap to finding a top-rated car insurance company in the United States. Not just a cheap one, not just a popular one, a genuinely great one. By the end of this, you will have a rock-solid framework to analyze any insurer and make a decision with total confidence, potentially saving you not just hundreds, but thousands of dollars in the long run. Because here's a statistic that should make you angry. A recent study found that nearly half of all American drivers believe they are overpaying for car insurance, and they're right. The average overpayment is over $850 per year. That's a flight to Europe. That's a new laptop. That's money being vacuumed out of your bank account for a policy that might not even protect you when you need it most. Why? Because most people fall into the same trap. They chase the lowest possible price. They see a commercial promising to save them 15% or more. They get a quote, and they sign on the dotted line thinking they've won. But this is the single biggest, most dangerous myth in the entire insurance industry. That the cheapest policy is the best policy. Let me be crystal clear. The cheapest insurance policy can easily become the most expensive mistake you ever make. It's the policy that has a nightmarish claims process that takes months to resolve. It's the policy that lowballs your car's value after a total loss. It's the policy from a company that is so financially unstable, it could go bankrupt right when you need it to pay out a major claim. Suddenly, that $30 a month you saved feels pretty insignificant when you're on the hook for a $50,000 liability judgment. So how do we avoid this? We stop shopping for price and we start shopping for value. We stop being consumers and we start being investigators. And our investigation is built on 3 core pillars. 3 non-negotiable qualities that every top-rated insurance company must have. If a company fails on even one of these pillars, you walk away. No exceptions. These 3 pillars are financial stability, customer service and claims handling, and coverage and customization. Let's start with the first and most fundamental pillar. Financial stability. This is the bedrock. Everything else is irrelevant if the company doesn't have the money to pay its claims. Think about it. An insurance policy is just a piece of paper, a promise to pay. If the company behind that promise is built on a shaky financial foundation, that paper is worthless. It's like hiring a bodyguard who looks tough but faints at the first sign of trouble. So how do you, a regular person, peek inside the vault of a multi-billion-dollar insurance corporation? It's actually easier than you think. You use the work of professional rating agencies. These are the financial detectives of the insurance world. Their entire job is to analyze an insurer's financial health, their cash reserves, their investment strategies, their debt, and assign them a simple letter grade, just like a report card. There are 3 main rating agencies you need to know in the US: AM, Best, Moody's, and Standard & Poor's, or S&P AM. Best is the one that specializes exclusively in the insurance industry, so it's often considered the gold standard. When you look up a company on AM Best, you'll see a grade. It'll be something like A++, A+, A-B++, B+, and so on. Now this can seem a little confusing, but here's a simple translation. Anything in the range from A all the way up to A++ is considered excellent or superior. This means the company has a massive financial cushion. It can withstand economic downturns, major natural disasters with thousands of claims, and still have more than enough cash to pay you and every other policyholder without breaking a sweat. These are the companies you want. These are the companies built on solid rock. Then you have the B range like B++ and B+. This is considered good. Fine. They'll probably pay your claim. But there's a noticeably higher risk compared to the A-rated companies. It's like a house that passes inspection but has a few notes from the inspector about watching the foundation. Anything below that, in the C range or lower, is a massive red flag. These companies are considered marginal, weak, or poor. Signing a policy with one of them is like gambling with your financial future. So here is your first concrete, actionable rule. Never, under any circumstances, sign a policy with an insurance company that has a financial strength rating lower than an A- from AM Best or its equivalent from Moody's or S&P. I don't care if they offer you a policy for $1 a month. It's not worth the risk. The peace of mind that comes from knowing your insurer can actually afford to help you is priceless. You can find these ratings for free. Just go to the AM Best website, or simply Google the name of the insurance company followed by AM Best rating. Do this for every single company you get a quote from. Make it the very first step in your screening process. If they don't make the grade, they're out of the running. Period. This one simple check can save you from a potential catastrophe down the road. It takes 30 seconds, and it's the single most important piece of due diligence you can perform. But a company with a perfect financial report card isn't the whole story. A fortress of cash is useless if you can't get past the gatekeepers. What happens when that A++ rated company has a customer service department that treats you like a number, or a claims process designed to frustrate you into giving up? That's where our second pillar comes in. And it's the one that truly separates the good companies from the ones you'll rave about to your friends. Customer service and the claims experience. This is the heart and soul of an insurance company. Think about it. You can pay your premium for years, decades even, without ever really needing them. It's an invisible product. But the moment you do need them, the moment you hear that sickening crunch of metal, the moment your heart is pounding and your hands are shaking, that is the moment of truth. That's when you discover what you've actually been paying for. Was it just a piece of paper? Or was it a promise? Let's be brutally honest. Anyone can set up a slick website and a call center that's friendly when they're trying to take your money. The real test is what happens after a crash. Imagine this scenario. It's a rainy Tuesday evening. You're stopped at a red light and bam, someone rear-ends you. It's not a huge accident, but your neck is sore, your bumper is hanging off, and your car is definitely not drivable. You do everything right. You exchange information, you take pictures, you file a police report. Then you call your insurance company's 24/7 claims hotline, and you're immediately put on hold for 20 minutes. When someone finally picks up, they sound bored, rushed. They give you a claim number and tell you an adjuster will call you back within 48 business hours. 48 hours? You don't have a car to get to work tomorrow. You ask about a rental car. They tell you that has to be approved by the adjuster first. So you wait, and you wait. The adjuster finally calls, but they're hard to get a hold of after that. Emails go unanswered. Voicemails are not returned. The body shop is telling you the insurance company is lowballing the estimate and refusing to pay for original manufacturer parts. Every single step of the process is a fight. Every conversation leaves you feeling more stressed and more alone than the last. You're the victim of the accident, but you feel like you're being treated like a criminal by the very company you paid to protect you. That right there is the nightmare scenario, and it happens every single day. Now let's flip the script. Same accident, same rainy Tuesday, but this time when you call the claims number, a real empathetic human being answers in under a minute. They ask first if you're okay. They calmly walk you through the next steps. While you're still on the phone, they text you a link to schedule a tow truck and arrange for a rental car to be ready for you first thing in the morning. Your assigned claims adjuster calls you within 2 hours, introduces themselves, gives you their direct line, and promises to keep you updated. They work directly with a high-quality, certified repair shop. They handle the negotiation. They approve the use of OEM parts to ensure your car is repaired correctly. They check in with you, not the other way around. The check for your medical bills arrives promptly. The entire process, while still stressful because of the accident itself, is smooth, professional, and compassionate. You feel supported. You feel like you have a powerful ally in your corner. That's the difference. It's not about the price anymore. It's about peace of mind. It's about turning a traumatic event into a manageable inconvenience. So, how on earth do you figure out which company offers that second experience before you have a claim? Seems impossible, like trying to predict the future. But it's not. There are powerful data-driven tools at your disposal that most consumers have never even heard of. First, let's talk about the gold standard, the J.D. Power U.S. Auto Claims Satisfaction Study. This isn't some fluffy online poll. J.D. Power has been doing this for decades. They survey thousands and thousands of real customers who have recently gone through the claims process. They're not asking, "Do you like your insurance company?" They're asking detailed, specific questions about every single step. They measure things like the first notice of loss. How easy was it to report the claim? The claim servicing. Was your adjuster courteous, professional, and accessible? The estimation process. Was the appraisal of the damage fair and accurate? And finally, the settlement. Were you happy with the final payout and how quickly you received it? Companies are then given a score out of 1,000. This is your first major clue. Go to the J.D. Power website, it's free, and look up the latest study. You'll see the industry average score. Your goal is to find companies that are consistently, year after year, scoring well above that average. Some companies live in that top tier. Others are perpetually stuck at the bottom. This isn't an accident. It's a reflection of their corporate culture. Do they invest in training their adjusters? Do they empower their employees to solve problems? Or do they incentivize them to delay and deny claims to save the company money? The J.D. Power score tells a huge part of that story. But we can go even deeper. We can get even more granular with a tool that is arguably even more powerful, because it measures the worst-case scenarios. I'm talking about the National Association of Insurance Commissioners, or the NAIC. Every state has an insurance department that fields official complaints from consumers against their insurance companies. The NAIC collects all of this data from all 50 states and compiles it into something called a complaint ratio. This is pure genius. It's not just the raw number of complaints, because a giant company will naturally have more complaints than a tiny one. Instead, the ratio compares a company's share of complaints to its share of the market. The national median is always set at 1.0. So, a company with a complaint ratio of 2.0 has twice as many complaints as you'd expect for its size. A company with a ratio of 0.5 has half as many. This is your red flag detector. You can go right to the NAIC website, look up any insurance company, and see its complaint ratio. Is it below 1.0? Great. That's what you want to see. Is it well above 1.0? Run. Seriously. This number tells you that, proportionally, this company is generating a lot of unhappy customers. Customers so frustrated they took the time to file a formal government complaint. These aren't just bad reviews. These are documented disputes. Looking at this single number can help you dodge a massive bullet. Finally, after you've looked at the big objective data from J.D. Power and the NAIC, it's time to look at the qualitative human stories. This is where you dive into online reviews, forums, and sources like Consumer Reports. But you have to be smart about it. Don't just look at the star rating. Anyone can have a few screaming one-star reviews from disgruntled people, or a bunch of 5-star reviews from people who have never filed a claim and are just happy about their low price. You need to read for patterns. When you read the negative reviews, what is the theme? Are people consistently complaining about slow claims processing? Are they mentioning the same issue with lowball repair estimates over and over? Is there a pattern of adjusters being rude or impossible to reach? If you see the same specific complaint repeatedly, that's not just noise. That's a signal of a systemic problem. Conversely, read the positive reviews. Are they just saying great price? Or are they telling detailed stories about a claims experience? A review that says, "My agent Brenda was a lifesaver after my accident. She handled everything and checked on me every few days," is worth 100 reviews that just say cheap insurance. You're looking for evidence that the company delivers on its promise when things go wrong. Combining these three things, the high-level satisfaction data from J.D. Power, the hard-nosed complaint data from the NAIC, and the real-world stories from actual customers, gives you a powerful three-dimensional view of a company's soul. It allows you to see past the clever marketing and the funny commercials to what really matters: how they treat people in their darkest hour. Because paying for car insurance shouldn't feel like a gamble. It should feel like an investment in security, in support, and in your own peace of mind. So you've now found a company that's financially solid, offers a competitive price, and has glowing reviews for its customer and claims service. You're all set, right? You've won the insurance game. Not so fast. Because the best claims adjuster in the world and the most financially stable company on the planet can't help you if the policy you actually bought doesn't cover what you think it covers. That dense, boring document filled with legal jargon is where the real traps are hidden. And the coverage gaps that most people don't even know exist are the ones that can lead to financial ruin. In our next part, we're going to pull that policy apart line by line and demystify the coverages that truly matter and the ones you absolutely cannot afford to skip. So let's pull it apart. Imagine this: you're driving home, fiddling with the radio for just a second, and bam! You rear end the car in front of you. It's a low-speed collision, everyone seems okay, but there's a sickening crunch of metal. You get out, your heart is pounding, and you see the other driver rubbing their neck. This single moment is where your entire financial future is decided, and it all comes down to a few lines of text on your insurance policy. The very first thing you need to understand is liability coverage. This is the absolute bedrock of any policy. It is not for you. It is not for your car. It is for the damage you do to other people and their property. This is so critical, I'm going to say it again. Liability coverage pays for the mess you make. It's broken into two crucial parts. First, there's bodily injury liability. This covers the medical expenses of the people in the other car, and not just the initial ambulance ride and emergency room visit. We're talking about potential surgery, physical therapy for months, lost wages because they can't work, and the big one, pain and suffering. That person you hit, the one rubbing their neck? A week later, their doctor diagnoses severe whiplash that requires ongoing care. They hire a lawyer, and suddenly that little fender bender is a $100,000 lawsuit. Your bodily injury liability is the only shield you have standing between that lawsuit and your life savings. Second, there's property damage liability. This is the part that pays to fix or replace the car you hit. You might think, okay, a few thousand for a bumper, no big deal. But what if you didn't hit a 10-year-old Honda? What if you glanced off a brand new Mercedes S-Class, a Rivian truck, or a Tesla Model S Plaid? You could easily be looking at $20,000, $30,000, even $50,000 in repair costs for a single vehicle. And it's not just cars. If you swerve and take out a city light pole, a custom-built brick mailbox, or even the corner of a storefront, your property damage liability is what pays for it. Now here's the trap. Every state has a legal minimum amount of liability coverage you're required to carry. And millions of people think, if it's the legal minimum, it must be enough. This is one of the most dangerous financial myths in America. Many states have minimums as low as $25,000 for bodily injury to one person, and just $10,000 or $15,000 for property damage. Think about that. The average price of a new car today is nearly $50,000. If you total one, a $15,000 minimum doesn't even cover a third of the cost. The rest? That comes from you. They will garnish your wages. They will put a lien on your house. They will drain your bank accounts. Opting for state minimum liability is like trying to stop a hurricane with a screen door. It's financial suicide. Okay, so the other person's medical bills and their car are handled by your liability coverage. But now you look at your own car. The hood is buckled, the radiator is leaking, it's undrivable. Your liability coverage will not pay one single penny to fix it. This is where the next layer comes in: collision coverage. Collision is exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another object. Whether that's another car, a pole, a guardrail, or even a pothole that sends you into a curb. It doesn't matter if the accident was your fault or not. If your car is damaged in a crash, collision is the coverage that gets it fixed. When you buy collision, you'll choose a deductible. This is the amount of money you have to pay out of your own pocket before the insurance company pays the rest. A common deductible is $500 or $1,000. So if you have a $1,000 deductible and the repairs cost $8,000, you pay the first $1,000, and the insurance company pays the remaining $7,000. Choosing a higher deductible will lower your monthly premium, but it means you need to have more cash on hand if something happens. It's a calculated risk you have to decide on for yourself. But what if the damage doesn't come from a crash? You get your car back from the body shop, and a week later, a giant hailstorm pummels your city, leaving your car looking like a golf ball. Or you're parked downtown and someone smashes your window and steals your laptop. Or a deer decides to use your front grille as a shortcut across the highway. None of these are collisions. This is where the third essential piece of the puzzle comes in: comprehensive coverage. Think of comprehensive as the acts of God and chaos coverage. It covers almost everything else: theft, vandalism, fire, flooding, hail, falling objects like tree branches, and hitting an animal. Just like collision, it comes with a deductible that you choose. For most people who have a car that's worth more than a few $1,000s, Carrying both collision and comprehensive is a no-brainer. Together, they are often called full coverage, and they are what ensures that the asset you drive every day, your car, is actually protected. So now we've protected the other guy and we've protected your car. But we've forgotten someone incredibly important. You and your passengers. What about your medical bills? You might say, I have health insurance for that. And you're right, but health insurance has deductibles, copays, and coverage limits. And it certainly won't cover the medical bills for your friends or family who are in the car with you. This is where you need a coverage called either medical payments, often called MedPay, or personal injury protection, known as PIP. Which one is available depends on your state. MedPay is straightforward. It covers a set amount of medical expenses for you and your passengers, regardless of who was at fault in the accident. It's a great way to cover your health insurance deductible, or for passengers who might not have good coverage. PIP is more robust and is required in no-fault states. It not only covers medical bills but can also cover things like lost wages if you can't work after an accident, and even services you might need to hire, like childcare. It's an immediate financial cushion after a crash. Now for the final terrifying scenario, the one that keeps me up at night. What if you do everything right? You're sitting at a red light, and someone plows into the back of you. It's clearly their fault, but then you find out they have no insurance. Or, just as bad, they have one of those useless state minimum policies that won't even begin to cover your $100,000 hospital bill and your totaled $60,000 SUV. Now what? You can sue them, sure, but you can't get blood from a stone. If they don't have insurance, they probably don't have assets. This is where the single most important coverage you can buy comes into play: uninsured and underinsured motorist coverage. This is you insuring yourself against the irresponsibility of other drivers. If you are hit by someone with no insurance, your uninsured motorist coverage kicks in and acts like the policy they should have had. It pays for your medical bills, your lost wages, your pain and suffering. It's your own insurance company saving you from someone else's mistake. The underinsured part is just as crucial. It kicks in when the at-fault driver has insurance, but their liability limits are too low to cover your damages. Your underinsured motorist coverage pays the difference, up to the limits you select. Across the United States, an average of 1 in every 8 drivers is on the road illegally with no insurance. In some states, it's as high as 1 in 4. Skipping this coverage is gambling with your life and health every single time you get behind the wheel. So there it is. The 5 foundational pillars of a rock-solid car insurance policy: liability, collision, comprehensive, medical payments or PIP, and uninsured/underinsured motorist. These are the coverages that separate a policy that just makes you legal from a policy that actually protects you and your family from financial devastation. We've built the structure, but the real devil is in the details, in the numbers behind each of these coverages. So let's pull back the curtain on those numbers. The most important, the ones that can literally save you from bankruptcy, are your liability limits. This is the money your insurance company will pay out to other people when an accident is your fault. You'll always see it written as a series of 3 numbers, like 25/50/25. This is the secret code of your financial exposure. That first number is the maximum amount, in thousands of dollars, your policy will pay for bodily injury to a single person in an accident you cause. The second number is the maximum it will pay for bodily injury for all people combined in that same accident. And the third number is the maximum it will pay for property damage. Now, every state has a legal minimum you're required to carry. And this is, without a doubt, the single biggest trap in the entire insurance industry. Many states have minimums around that 25/50/25 mark. $25,000 for one person's injuries, $50,000 total for everyone's injuries, and $25,000 for property damage. To the average person, $50,000 sounds like a lot of money. The insurance company sells you this policy, the state says you're legal, and you feel protected. You're not. You're holding a policy that is functionally useless in a modern, moderately serious accident. Carrying state minimum liability is like showing up to a house fire with a water pistol. It makes you feel like you're doing something, but the house is still burning down. Let's paint a picture. You're driving on a rainy Tuesday morning. You glance down at your phone for just a second. It happens, and you don't see the traffic ahead has stopped. You slam on your brakes, but it's too late. You rear-end a brand new Audi Q5. It's not a horrific multi-car pileup. It's the most common type of accident in America. Inside the Audi are a husband and wife. The impact wasn't huge, but their airbags deployed. They're shaken up, complaining of neck and back pain. An ambulance is called. Your car is crumpled. Their SUV has significant rear-end damage. Let's do the math. The ambulance ride to the hospital? In many parts of the country, that's $2,000 to $3,000 per person. So we're already at $6,000 before they've even seen a doctor. At the emergency room, they get CT scans to check for serious injury, they get x-rays, they see a doctor. That's easily another $5,000 to $10,000 per person. We are now potentially at $26,000 in medical bills, and they haven't even started treatment. Your 25/50/25 policy has a $25,000 limit per person. You have already blown past that limit for one of the victims. And the $50,000 total limit for the accident? We're already over halfway there. And the real costs haven't even begun. What comes next? Physical therapy. Weeks, maybe months of it. That's thousands more. What if one of them is a surgeon or a freelance consultant and can't work for a month because of the pain? That's lost wages. You're on the hook for that too. Tens of thousands of dollars. And let's not forget the scariest part, pain and suffering. That's the legal term for the compensation they can sue you for the sheer trauma and disruption to their lives. Your $50,000 bodily injury limit is a distant memory. The total medical bills, lost wages, and settlement could easily hit $150,000. So your policy pays out its max of $50,000. Who pays the remaining $100,000? You do. And how do they get it? Their attorney will come after everything you own and everything you will ever own. They will get a judgment against you. They can put a lien on your house. They can garnish your wages for years, taking a percentage of every single paycheck until that debt is paid. Your dream of saving for retirement, for your kids' college, for a better life? Gone. Wiped out by one moment of inattention and a piece of paper that gave you a false sense of security. And we haven't even talked about the Audi Q5 you hit. That third number on your policy, the $25,000 for property damage. A new Audi Q5 costs over $50,000. With modern cars full of sensors, cameras, and computers, a simple rear-end collision can easily cause $30,000, $40,000, even $50,000 in damage. Your policy pays the first $25,000. You are personally on the hook for the rest. So you're now facing $100,000 in medical debt and another $15,000 in property damage debt. Your life is fundamentally and financially altered forever. All because you chose the cheapest legal option. So what's the real answer? The absolute bare minimum a responsible adult with any assets or income to protect should carry is $100,000/300/100. $100,000 for a single person's injuries, $300,000 total for all injuries, and $100,000 for property damage. This is the new floor. This is your starting point. If you own a home or have significant savings, you should be looking at $250,000/500/100 or even higher. And we'll talk about the magic of umbrella policies in a later part. The difference in premium between a state minimum policy and a truly protective $100,000/300/100 policy is often just a few dollars a month. It is the single best investment you will ever make. But that's only half the story. Liability protects you when you hurt someone else. What happens when someone else hurts you? Specifically, what happens when they're one of the nearly 13% of drivers in the United States who are driving with absolutely no insurance? Or they're the person who bought that state minimum policy we just talked about, and your medical bills are $100,000 but they only have $25,000 in coverage? This is where uninsured and underinsured motorist coverage comes in. This is the coverage that protects you from the irresponsibility of others. It steps in and acts like the at-fault driver's insurance when they don't have any, or don't have enough. You get hit by an uninsured driver and break your leg, facing massive medical bills and months off work? Your uninsured motorist bodily injury coverage pays for it. Your car is totaled by a hit-and-run driver? Your uninsured motorist property damage coverage pays for it. The rule here is simple and non-negotiable. Your uninsured and underinsured motorist limits should always match your liability limits. If you have $100,000/300 in liability, you get $100,000/300 in UM/UIM coverage. Why on earth would you buy a policy that protects a stranger you might hit for more than it protects you and your own family? It makes no sense. This coverage is your shield against a huge and growing problem on our roads, and it is shockingly affordable. Finally, let's talk about the immediate aftermath of an accident. Before the lawyers, before the big settlements, there are immediate bills. The ambulance, the emergency room copay, your health insurance deductible, which can be $5,000, $7,000, even $10,000. This is where medical payments coverage, or MedPay, comes in. In some states, it's called personal injury protection, or PIP, and it's more comprehensive. Think of MedPay as the emergency cash fund in your policy. It pays for your and your passengers' immediate medical expenses after an accident, regardless of who is at fault. There's no deductible, no waiting for a settlement. You go to the ER, you get a bill for $2,000, you submit it to your MedPay, and it gets paid. It's that simple. It bridges the gap before your health insurance kicks in, covering those painful deductibles and copays. For the cost of a couple of lattes a month, you can get $5,000 or $10,000 in MedPay coverage. It's an absolute no-brainer. It removes the immediate financial stress from a physically and emotionally traumatic event. These three coverages, liability, uninsured/underinsured motorist, and MedPay/PIP, form the protective bubble around the people in the car. They are the core of what insurance is for. Managing catastrophic financial risk from injury. We've fortified the walls of our financial fortress. But what about the fortress itself? What about the 2-ton, $30,000, $40,000, $50,000 machine you're actually driving? Protecting your vehicle from the chaos of the road requires two entirely different types of coverage, and that's where we're going next. Let's talk about collision coverage first. The name is pretty self-explanatory. This is the coverage that pays to repair or replace your car if it's damaged in a collision with another object. That object could be another car, a telephone pole, a guardrail, a fire hydrant, or even the wall of your own garage. It also covers damage from a rollover. The single most important thing to understand about collision coverage is that it pays out regardless of who is at fault. Let that sink in for a second. If someone runs a red light and plows into your driver's side door, their liability insurance is supposed to pay for your car. But what if they're uninsured? What if they don't have enough coverage? What if they flee the scene and you never find them? Or what if the accident is 100% your fault? You misjudge a turn on a slick road and hit a tree. Your bodily injury and property damage liability won't give you a single dime for your own crumpled car. That fortress we talked about? It's designed to protect everyone outside the walls. Collision coverage is the armor that protects the king inside the fortress. It's what fixes your ride. Now, this coverage isn't a blank check. It comes with a critical component called a deductible. The deductible is the amount of money you have to pay out of your own pocket for a claim before the insurance company starts paying. Think of it as your skin in the game. Deductibles typically range from $250 up to $2,000 or more. The most common are $500 and $1,000. Here's how it works in the real world. Let's say you have a $1,000 deductible on your collision coverage. You have that unfortunate meeting with a tree, and the body shop estimates the repairs will cost $7,000. You pay the first $1,000 directly to the body shop. Your insurance company then pays the remaining $6,000. If the damage was only $800, you'd pay the full amount yourself because it's less than your deductible. You wouldn't even file a claim. Choosing your deductible is a strategic financial decision. A higher deductible means you're taking on more risk yourself, so the insurance company rewards you with a lower premium, a lower monthly or semi-annual bill. A lower deductible means the insurance company is on the hook for more money, so they charge you a higher premium. It's a classic trade-off between short-term cost and long-term risk. So that's collision. But what about all the other terrible things that can happen to a car that don't involve a crash? What about the hailstorm that turns your car's roof into a golf ball? The tree branch that snaps in a windstorm and crushes your hood? The thief who smashes your window and steals your car from a parking garage? What about hitting a deer on a dark country road? None of those are a collision in the traditional sense. For all of that, you need the second type of vehicle protection: comprehensive coverage. Comprehensive is best understood as everything else coverage. It's sometimes called other than collision coverage, which is a perfect description. It covers a huge range of non-collision incidents: theft, vandalism, fire, floods, hail, wind, falling objects, riots, and crucially, contact with an animal. Yes, hitting a deer, one of the most common and expensive claims in many states, is covered under comprehensive, not collision. Just like collision, comprehensive coverage has its own deductible. You can choose to have them be the same amount, say $500 for both, or you can mix and match. Maybe you live in an area with a lot of deer, but you're a very safe driver, so you opt for a lower comprehensive deductible and a higher collision deductible. The flexibility is there. Now, a critical point about both of these coverages. In nearly every state, they are optional. No law says you have to buy them. But, and this is a massive but, if you have a loan on your car or you are leasing it, your lender or leasing company will almost certainly require you to have both collision and comprehensive coverage. Why? Because until you pay off that loan, the car isn't technically yours. It's the bank's asset. It's the collateral for the loan they gave you. They are not going to let you drive their multi-thousand-dollar asset around without a guarantee that if it gets wrecked or stolen, their investment is protected. They will mandate that you carry this coverage, and they'll often specify the maximum deductible you're allowed to have. If you drop it, they have the right to buy a policy for you, a very expensive one, and tack the cost onto your car payment. So, if you have a loan or lease, the decision is made for you. You need them. But what if you own your car outright? What if you drove that car off the lot 10 years ago and have the title free and clear sitting in a safe at home? Now you have a choice to make. Do you keep paying for collision and comprehensive? This is where you need to become your own financial advisor. The decision boils down to one simple question. If your car were totaled tomorrow, could you afford to repair or replace it without putting yourself in a major financial hole? To answer that, you first need to know what your car is actually worth. Not what you paid for it. Not what it's worth to you sentimentally. You need to know its actual cash value or ACV. This is the value of the car right before the loss, and it accounts for depreciation, mileage, and condition. You can get a good estimate by looking up your car's private party value on sites like Kelley Blue Book or Edmunds. Let's say your car's ACV is $8,000. Now look at your finances. Do you have $8,000 or something close to it in an emergency fund that you could use to buy a similar car? If the answer is a comfortable yes, then you might consider dropping collision and comprehensive and self-insuring. You're betting that the money you save on premiums over the next few years will be more than the potential cost of replacing the car. But if your car is worth $8,000 and you have $500 in your savings account, then losing that car would be a catastrophe. You depend on it to get to work, to take your kids to school. In that case, paying for collision and comprehensive is not a luxury. It's a critical safety net protecting your ability to function in the world. A useful rule of thumb many financial experts use is the 10% rule. The rule states that if the annual cost of your collision and comprehensive coverage is more than 10% of your car's actual cash value, it may be time to consider dropping it. Let's do the math. Suppose your car is an older sedan with an ACV of $4,000. 10% of that is $400. You check your insurance policy and see that the portion of your premium for comprehensive and collision adds up to $600 per year. According to this rule, you're paying $600 to protect a $4,000 asset. It might be time to drop the coverage, put that $600 a year into a dedicated car replacement savings account, and take your chances. Conversely, if your car is worth $15,000, 10% of that is $1,500. If your comp and collision coverage only costs $700 a year, it's still providing excellent value and is likely worth keeping. This isn't a hard and fast law. It's a guideline. Your personal risk tolerance matters. If the thought of a surprise $4,000 expense would keep you up at night, you might decide to keep the coverage even if it breaks the 10% rule, just for the peace of mind. So, to recap, liability protects everyone else from you. Collision and comprehensive protect your car. Collision is for crashes. Comprehensive is for basically everything else. They both have deductibles, and they are required by lenders for financed cars. If you own your car outright, you must weigh its value against your own financial ability to replace it. These coverages ensure that a physical loss, a wreck, a theft, a storm, doesn't become a total financial wipeout. But we've only covered damage to property, the other guys, and your own. What about the most valuable thing of all? What about the people inside the car? What about your own medical bills if you're injured, regardless of who's at fault? That's a whole different layer of protection, and it's absolutely vital. This is where the financial and emotional stress of an accident truly begins to compound. The ambulance ride, the emergency room visit, the x-rays, the follow-up appointments with specialists. These bills arrive with terrifying speed, long before anyone has even decided who is at fault, while the other driver's liability insurance is supposed to pay if they cause the crash. That can take weeks, months, or even years to resolve if there's a dispute. In the meantime, those medical bills are your problem. Your health insurance might kick in, but what about your massive deductible? What about the co-pays? What about your passengers who might be friends or family members? Are you going to ask them to drain their savings account because they were in your car? This immediate, terrifying gap in coverage is precisely what two specific types of insurance are designed to fill: medical payments coverage, often called MedPay, and personal injury protection, known as PIP. Let's start with MedPay. Think of medical payments coverage as the financial first aid kit for your car insurance policy. It's relatively inexpensive, and its purpose is beautifully simple. It pays for reasonable and necessary medical and funeral expenses for you and your passengers after an accident, regardless of who is at fault. I want to repeat that because it's the most important part, regardless of who is at fault. If you get rear-ended, MedPay can cover your emergency room copay immediately. If you accidentally cause the accident, MedPay still covers your injuries and the injuries of your passengers. It's a no-fault, no questions asked about fault anyway, coverage that provides immediate relief. It typically covers things like health insurance deductibles, visits to the doctor, surgery, x-rays, dental care if your teeth are damaged in the crash, and even ambulance fees. The coverage limits are usually on the lower side, often ranging from $1,000 to $10,000, but that immediate injection of cash can be the difference between getting the care you need right away and waiting in pain while the insurance companies argue. It's peace of mind in its purest form. Now let's talk about its bigger, more comprehensive sibling, personal injury protection, or PIP. If MedPay is the first aid kit, PIP is the entire ambulance, hospital stay, and rehabilitation facility combined. Like MedPay, PIP is also a no-fault coverage, meaning it pays out for your injuries no matter who caused the accident. But it goes so much further. While MedPay is strictly for medical bills, PIP is designed to help you recover your life. The most significant difference is that PIP can cover lost wages. If an injury from a car accident forces you to miss 2 months of work, PIP can replace a percentage of your lost income, keeping your family afloat while you recover. This is a game changer. Your regular health insurance will never do that. Your MedPay won't do that. For millions of Americans who live paycheck to paycheck, lost wages from an injury can be even more devastating than the medical bills themselves. But PIP doesn't stop there. It can also cover rehabilitation costs, like physical or occupational therapy, and it can even cover what are called essential services. Imagine you break your leg and can't take care of your children, or you can't do the cooking and cleaning around the house. PIP can provide money to hire someone to help with those tasks. It is an incredibly robust form of coverage designed to make you whole again, not just patch up your physical injuries. Now, here's where it gets a little complicated, and where knowing your state's laws is absolutely critical. The United States has a patchwork of insurance systems. Some states are traditional at-fault states, where the person who causes the accident is responsible for the damages. Other states are called no-fault states. In these no-fault states, you are generally required by law to carry PIP. The whole idea is to reduce lawsuits and ensure that every injured person gets immediate medical care and financial support from their own insurance company, without having to wait to prove who is at fault in court. States like Florida, Michigan, New York, and a handful of others are mandatory PIP states. If you live there, you don't have a choice, you must buy it. In other states, PIP might be offered as an optional coverage you can add to your policy. And in some states, it's not available at all, making MedPay your only option for this kind of no-fault medical coverage. So this brings up the big question: if you have a choice, which one should you get? And if you have great health insurance, do you even need either of them? Let's tackle the health insurance question first, because it's the #1 reason people skip this coverage. You might have a fantastic plan through your employer with a low deductible. Great. But does your health insurance cover lost wages? No. Does it cover hiring someone to help around the house? No. Does it cover funeral expenses? No. And most importantly, does your health insurance cover the friends, family, or co-workers riding as passengers in your car? Absolutely not. They're on their own. Having MedPay or PIP makes you a responsible host to anyone who gets in your vehicle. It ensures there's a safety net for them, paid for by your policy, so an accident doesn't destroy your relationship along with your car. Furthermore, even with great health insurance, MedPay and PIP can act as your primary coverage. This means they pay out first before your health insurance even gets involved. This can be used to pay your entire health insurance deductible, so you have zero out-of-pocket medical costs. It's an insurance policy for your health insurance policy. So, if you live in a state where you have a choice between MedPay and PIP, the decision often comes down to cost versus comprehensiveness. PIP will always be more expensive, but the value it provides, especially the lost wages component, is immense. If you are self-employed, an hourly worker, or don't have robust short-term disability insurance through your job, PIP is an absolute necessity. It becomes your financial lifeline. MedPay is the more budget-friendly option, and it's a fantastic choice if your main concern is just covering initial medical expenses and health insurance deductibles for both yourself and your passengers. This is another area where a top-rated insurance company truly shines. A great agent or a well-designed online quote tool from a top-tier company will not just sell you a policy, it will educate you. It will clearly explain your state's specific requirements. Are you in a no-fault state? They'll tell you exactly how much PIP you're required to carry. Are you in an at-fault state? They'll present the options for MedPay and optional PIP, explaining the pros and cons of each limit so you can make an informed decision for your family's financial security. A lesser company might just gloss over it or default to the state minimum, leaving you dangerously exposed. A great company understands that the speed at which they pay out a MedPay or PIP claim is critical. When you're injured and out of work, you can't wait 30 days for a reimbursement check. Top companies excel at processing these claims quickly, often paying medical providers directly, because they know this is the moment of truth. This is where they prove their value. So we've now covered your car with collision and comprehensive. We've covered the other person's car and property with property damage liability. We've covered their medical bills with bodily injury liability. And now we've covered your own immediate medical bills, and even your lost income with MedPay and PIP. Feels like we've covered every possible angle, right? We've built a fortress of financial protection. But there's a ghost in the system. A massive, terrifying risk that millions of drivers face every single day. What happens when the person who hits you has no insurance at all? Or they have the bare minimum coverage that doesn't even begin to pay for your new reality as a seriously injured person? That's when your fortress needs one more critical line of defense. This defense is called uninsured and underinsured motorist coverage. And it is, without a single shred of doubt, one of the most important and most tragically overlooked coverages you can buy. Because this isn't about protecting you from your own mistakes. This is about protecting you from the financial black hole left behind by someone else's. Let's get the numbers out of the way first because they're staggering. The Insurance Research Council estimates that 1 in 8 drivers on the road in the United States is uninsured. 1 in 8. In some states like Mississippi and Florida, that number is closer to 1 in 4. Think about that. On your average commute, you will pass dozens, maybe hundreds of cars. Statistically, a significant number of them are rolling liabilities, one mistake away from ruining your life with absolutely no way to pay for it. When one of these drivers slams into you, their lack of insurance becomes your catastrophe. Your medical bills, your lost income from being unable to work, your long-term physical therapy, the modifications to your home if you're permanently injured, all of it lands squarely on your shoulders. You can sue them, sure, but you cannot get blood from a stone. If they couldn't afford a few $100s for a basic insurance policy, they don't have the $50,000, $200,000, or $1 million needed to make you whole again. This is where uninsured motorist bodily injury, or UMBI, comes in. It is your insurance company stepping into the shoes of the uninsured driver and paying you for what they should have. It covers your medical expenses, your lost wages, and that incredibly important but hard to quantify category, pain and suffering. Now, what about the second part of that name? Underinsured motorist. This is arguably even more common and just as dangerous. This is the driver who did the bare minimum. They bought the cheapest possible policy to stay legal, with liability limits of say $25,000. But your injuries are severe. You have a shattered leg, multiple surgeries, and you're out of work for 8 months. Your medical bills alone are $150,000, and your lost wages are another $40,000. That other driver's policy pays out its $25,000 limit, and then that's it. They're done. They've met their legal obligation. You are left with a $165,000 hole in your life. This is when underinsured motorist coverage, or UIM, kicks in. It bridges the gap. If you have UIM coverage up to $250,000, your policy would cover the remaining $165,000 that the at-fault driver's insurance couldn't. It is the safety net below the safety net. Now, I know what some of you are thinking, but I have great health insurance. I don't need to worry about medical bills. That is a dangerously incomplete thought. First, your health insurance has deductibles, copays, and out-of-pocket maximums that can still run into the thousands or tens of thousands of dollars. Second, health insurance will often fight you on covering certain treatments, like long-term chiropractic care or experimental procedures. But most importantly, your health insurance does not pay your mortgage. It does not buy your groceries. It does not put gas in your spouse's car so they can drive to the hospital to visit you. It does absolutely nothing to replace your lost income while you recover. Uninsured and underinsured motorist coverage does. It is the single best tool you have to protect your income and your lifestyle after a serious accident that wasn't even your fault. When you buy this coverage, you'll see limits just like liability. A common recommendation is to match your UM/UIM limits to your bodily injury liability limits. If you have 250-500 coverage to protect others from your mistakes, you should have the same 250-500 coverage to protect yourself from theirs. Don't value a stranger's well-being more than your own. And here's a pro tip. Ask your agent about stacking. In many states, if you have multiple cars on your policy, you can stack your uninsured motorist coverage. Let's say you have 3 cars and you have $100,000 in UM coverage on each. If you have an unstacked policy, your limit is $100,000, period. But if you pay a little extra for a stacked policy, you can combine the limits. Suddenly, you have $300,000 in protection. It is one of the most cost-effective ways to massively increase your personal safety net. Now, alongside this, there's another critical layer of personal protection, and it works a little differently. It's called either medical payments coverage, or MedPay, or personal injury protection, known as PIP. Which one you'll be offered depends on whether you live in a no-fault state or a traditional at-fault state. Let's start with PIP, because in about a dozen no-fault states it's mandatory. In these states like Florida, New York, and Michigan, the whole system is designed to handle minor to moderate injuries without long, drawn-out legal battles to determine who is at fault. If you're in an accident, your own PIP coverage is your first line of defense. It pays for your medical bills and a portion of your lost wages up to a certain limit, regardless of who caused the crash. It's fast, it's efficient, and it gets you the care you need immediately. In the majority of states which are at-fault states, you'll have the option to buy MedPay. It's similar to PIP but generally simpler. It covers medical and funeral expenses for you, your family members, and any passengers in your car, again, regardless of who was at fault. It doesn't typically cover lost wages. So why would you want MedPay if you have health insurance and you've loaded up on uninsured motorist coverage? 3 reasons: speed, scope, and simplicity. First, speed. MedPay pays out immediately. There's no waiting for the insurance companies to investigate and assign blame, which can take weeks or months. You go to the emergency room, you get the bill, and your MedPay can cover it right away. Second, scope. It covers your passengers. If you're driving your friends to lunch and get into a fender bender, your MedPay can cover their medical checkups. That's a huge benefit that can prevent awkwardness or even lawsuits from friends who might otherwise have to pay out of pocket. It also covers you and your family if you're a pedestrian or cyclist and get hit by a car. Third, simplicity. There are typically no deductibles or copays with MedPay. If you have a $5,000 MedPay limit, you have $5,000 of first-dollar coverage for health expenses. It can be used to pay your health insurance deductible, ambulance fees, dental work if your teeth are damaged in a crash, things that can be a real headache to get covered otherwise. Think of it this way: liability coverage is for them, comprehensive and collision are for your car. But uninsured/underinsured motorist and MedPay/PIP, these are for you. They are the coverages that protect your body, your health, your income, and your family's financial future from the chaos of the outside world. Skimping on these is like building a beautiful house but refusing to put locks on the doors. You've now designed a policy that is a true fortress. It protects your assets from lawsuits. It repairs or replaces your vehicle. And most importantly, it protects you and your passengers from the devastating financial fallout of an injury, even when the other person is irresponsible. You have the right coverages in the right amounts. But this fortress is just a blueprint, promise on paper. The strength of this entire structure depends entirely on the quality of the company that built it. How do you know that when the crisis hits, the company holding the keys will actually show up and unlock the treasury for you? How do you separate the companies that write great policies from the companies that are great at paying claims? Because the single most important factor in your peace of mind isn't just the coverage you buy. It's the character of the company you buy it from. So let's pull back the curtain. The character of an insurance company isn't some vague, feel-good concept. It's a measurable, quantifiable set of data points. You just have to know where to look. Think of it like this: when you buy a car, you can look up its crash test ratings from the government. When you buy insurance, there are organizations that do the exact same thing, but instead of testing crumple zones, they're testing financial stability and customer satisfaction during the absolute worst moments of a person's life. These are the secret scorecards, the industry report cards that separate the rock-solid protectors from the slick marketers. First, let's talk about the big name you've probably already heard of, J.D. Power. You see their awards on car commercials all the time. But what do they actually do? J.D. Power is a data and analytics firm that conducts massive, independent surveys of real customers. For car insurance, they have two key reports you need to pay attention to. The first is their U.S. auto insurance study. This one looks at the entire customer journey. How easy it was to shop for a policy, the billing and payment process, the clarity of the information they provide, and their overall customer service interactions. It's a great overview of the day-to-day experience. But the one that truly matters, the one that tests a company's character, is the J.D. Power U.S. Auto Claim Satisfaction Study. This report doesn't survey just any customer. It surveys customers who have recently filed a claim. These are the people who have actually put their policy to the test. They've been in an accident, their car was damaged or stolen, and they had to call their insurer for help. The study measures everything: the ease of reporting the claim, the fairness of the settlement, the quality of the repair process, and the communication from the claims representative. This is where the rubber meets the road. A company can have a flashy app and a great website, but if they get a low score on the claim satisfaction study, it's a massive red flag. It means that when their customers needed them most, they fell short. When you look at these studies, you'll see their famous Power Circle ratings. 5 circles is the best, 2 is the worst. You should be looking for companies consistently scoring 4 or 5 circles, especially in the claims department. The second major player is Consumer Reports. If J.D. Power is the industry standard for data, Consumer Reports is the undisputed consumer champion. They are fiercely independent. They buy all the products they test and accept no outside advertising. Their credibility is their entire business model. They conduct their own annual surveys of their tens of thousands of members about their car insurance experiences. They ask pointed questions about satisfaction with the premium, the quality of agent interactions, and crucially, their experience with the claims process. They then distill this down into a rating system that highlights the best and worst carriers. What's powerful about Consumer Reports is that its members are typically very discerning consumers. They are the type of people who do their homework. So, a high rating from this group carries a lot of weight. It's a stamp of approval from some of the smartest shoppers on the planet. Now, customer satisfaction is critical, but it's only half the story. The other half is something most people never even think to check: financial strength. Imagine this: you have a policy with a company that has amazing customer service. You get into an accident, they are incredibly polite on the phone, they process your claim quickly. But then the check bounces. Why? Because the company didn't have enough money to pay its bills. This isn't just a hypothetical nightmare. It happens. A major hurricane, a series of catastrophic wildfires, or just poor financial management can bankrupt an insurance company, leaving its policyholders completely unprotected. This is where an organization called AM Best comes in. AM Best isn't a consumer survey company. They are a credit rating agency, like Moody's or Standard & Poor's, but they specialize exclusively in the insurance industry. For over a century, their teams of financial analysts have been digging into the balance sheets of insurance companies. They look at a company's debt, its cash reserves, and its ability to pay out a massive number of claims all at once. Based on this deep financial analysis, they issue a letter grade from A++ all the way down to D. This grade is a direct reflection of their financial health and ability to meet their obligations to you, the policyholder. Here's the simple takeaway: you should never, ever sign up with a car insurance company that does not have an AM Best rating of A or better. And A rating, which stands for excellent, signifies that the company has a strong financial foundation and is very likely to be able to pay your claim, no matter how big it is or what's happening in the wider economy. Think of the AM Best rating as the foundation of the house. If the foundation is cracked, it doesn't matter how beautiful the paint is. So we have customer satisfaction from J.D. Power and Consumer Reports, and financial stability from AM Best. But there's one more source of data, and it might be the most powerful of all because it comes directly from the regulators who police the industry. This is the National Association of Insurance Commissioners, or the NAIC. Every state has a Department of Insurance that oversees the companies operating within its borders, and the NAIC brings them all together. One of the most important things they do is track consumer complaints. Every time a customer has a serious problem with an insurer, an unfairly denied claim, a massive delay in payment, a sudden unexplained cancellation, and they file an official complaint with their state's Department of Insurance, It gets logged into a national database. The NAIC then compiles this data into a complaint index. This is a beautifully simple and powerful metric. They calculate the national median number of complaints for every 1,000 claims. A company that is exactly average will have a complaint index of 1.0. A company that gets twice as many complaints as the average for a company its size will have an index of 2.0. And a company that performs better than average with only half the complaints will have a score of 0.5. You want to look for a company with a complaint index significantly below 1.0. The lower, the better. This isn't a survey of feelings. It's a hard data record of how many times a company has frustrated its customers to the point that they felt compelled to file a formal grievance with the government. You can easily search for a company's NAIC complaint index online. It's public information, and it's one of the most honest indicators of a company's character you will ever find. So, how do you put this all together? You triangulate the data. You don't just look at one source. You build a complete profile. You find a company that looks good on price, and then you run it through this checklist. Does it have a high J.D. Power score for claim satisfaction? Is it recommended by Consumer Reports? Does it have an A rating or better from AM Best? And does it have a low NAIC complaint index? A company that ticks all of these boxes is a company that has proven its character, not just with slick advertising, but with financial prudence and a track record of treating its customers right when it matters most. A quick word of caution: be wary of generic online review sites. While they can sometimes be helpful, they are often skewed. In the world of insurance, people are far more motivated to write a review after a terrible claims experience than they are after a smooth, uneventful year of just paying their premiums. This can create a distorted picture. That's why relying on the structured, data-driven analysis from J.D. Power, the financial rigor of AM Best, and the official complaint records from the NAIC gives you a much more reliable and objective view. This process takes a little bit of homework, maybe an extra 20 minutes of research. But those 20 minutes could be the difference between a smooth recovery after an accident and a months-long nightmare fighting for the money you're rightfully owed. The price on your quote is just the entry fee. The true value is found in these ratings, which tell you what will happen long after your check has been cashed. So where do you find these all-important report cards? And how do you read them without a degree in finance? Let's pull back the curtain on the industry's gatekeepers. The first and arguably most famous name you'll encounter is J.D. Power. You've seen their awards in car commercials for decades. But their ratings for insurance companies are far more than just marketing fluff. They are a direct reflection of what thousands of real customers, people just like you, have experienced. J.D. Power conducts massive annual studies, surveying policyholders about their overall satisfaction, their interactions when filing a claim, the price they pay, the policies offered, and how they interact with the company, whether it's through an agent, a website, or an app. They then distill all this data into a simple 1,000-point scale and a power circle rating system from 1 to 5 circles. Think of it like a star rating for a restaurant, but instead of judging a $10 burger, you're judging a company you trust with your financial well-being. Here's the inside track on reading these ratings. Don't just look at the national winners. J.D. Power breaks down their results by region, because the service you get from a company in California can be drastically different from the service in Florida or Texas. A company might be a national giant, but their operations in your specific state could be understaffed or poorly managed, leading to a frustrating experience. So find your state or region on their list. A company with 5 power circles, what they call among the best, is your gold standard. For circles or better than most, is still a very strong contender. 3 circles is average. Anything below that, 2 circles labeled the rest, should be a major red flag. It doesn't matter if they're $5 cheaper a month. A 2-circle rating is the market screaming that you'll likely pay for that discount with your time, your sanity, and your frustration when you need them most. But customer satisfaction is only one side of the coin. The other, equally critical side is financial strength. A company can have the friendliest agents and the slickest app in the world, but if they don't have the money to pay your claim after a major catastrophe, none of that matters. Imagine a massive hurricane hits a coastal state, causing billions in damages. Smaller, less stable insurance companies can be completely wiped out, unable to pay the flood of claims. This is where the financial strength ratings come in, and the undisputed heavyweight champion in this arena is AM Best. For over a century, AM Best has been the leading credit rating agency specializing in the insurance industry. They don't care about the hold music or the website design. They care about one thing: the company's ability to meet its ongoing insurance policy and contract obligations. In other words, can they pay their bills? Can they pay your claim? They analyze a company's balance sheet, their operating performance, and their business profile, and then assign a letter grade. This is much easier to understand than you think. An A++ or A+ rating is superior. It's the equivalent of a person with an 850 credit score. These companies are financial fortresses, incredibly stable and secure. An A or a dash rating is considered excellent, still a fantastic choice with a very strong ability to pay claims. Once you start dipping into the B ratings, you need to exercise caution. A B++ or B+ is considered good, but it signifies more vulnerability. Anything lower, and you're venturing into risky territory. My personal rule of thumb? Don't even consider a company that doesn't have at least an A- rating from AM. Best. Your peace of mind is worth it. 2 other quick resources to add to your arsenal are Consumer Reports and the National Association of Insurance Commissioners, or NAIC. Consumer Reports does its own independent surveys and provides excellent, unbiased rankings. The NAIC maintains a national database of consumer complaints. They generate something called a complaint ratio. A ratio of 1.0 is the national median, meaning the company gets an average number of complaints for its size. A ratio of 2.0 means they get twice as many complaints as their peers. A ratio of 0.5 means they get half. It's a brutally simple and effective way to see if a company is generating an unusual amount of unhappy customers. Okay, so you've done your homework. You've cross-referenced J.D. Power, checked the AM Best rating, and glanced at the NAIC complaint ratio. You've now identified 3 or 4 companies that are highly rated, financially solid, and respected by their customers. The hard part is over, right? Not quite. Now we move from vetting the company to customizing the product. Because the best insurers don't just sell you a one-size-fits-all policy. They hand you a menu of options and let you build a suit of armor that is perfectly tailored to your life. This is where you separate the good from the great. A great policy isn't just about having the state-mandated liability coverage. It's about the thoughtful add-ons and endorsements that can turn a potential financial disaster into a minor inconvenience. Let's look at the most important ones. First up, rental reimbursement. This sounds like a minor convenience, but it is one of the most valuable and yet inexpensive coverages you can buy. If you get into an accident and your car is in the shop for repairs, how are you getting to work? To school? To the grocery store? Without this coverage, you're paying for a rental car out of your own pocket. At $40, $50, or even $60 a day, a 2-week repair job can suddenly cost you over $700 you didn't budget for. For just a few extra dollars a month, rental reimbursement coverage kicks in and pays that bill for you. It's a no-brainer. Next, roadside assistance. Many companies offer this, and it often provides similar services to dedicated clubs like AAA, but for a fraction of the cost baked right into your policy. It covers things like towing, flat tire changes, jump starts, and lockout services. Before you add it, check to see if you already have it through your credit card or car manufacturer. But if you don't, adding it to your auto policy is one of the cheapest ways to ensure you're never stranded on the side of a dark highway. Now for a big one, especially if you have a car loan or a lease, gap insurance. This is absolutely critical. GAP stands for Guaranteed Asset Protection, and it covers the difference between what your car is worth and what you still owe on it. Cars depreciate fast. The moment you drive a new car off the lot, it's worth less than what you paid for it. If you total that car a year later, your insurance company will pay you its current market value, let's say $20,000. But what if you still owe the bank $24,000 on your loan? You're now on the hook for $4,000 for a car that is sitting in a junkyard. GAP insurance pays that $4,000 difference, saving you from making payments on a ghost. For those with brand new cars, there's an even better option called new car replacement coverage. This is a premium feature, but its value is immense. If your new car is totaled within the first year or 2 of ownership, the terms vary by company, this coverage doesn't just pay you the depreciated value. It pays for a brand new car of the same make and model. It completely erases the financial sting of depreciation in a total loss scenario. Finally, a detail many people overlook: OEM parts coverage. OEM stands for Original Equipment Manufacturer. When your car is repaired after an accident, the shop can use either OEM parts, which are made by your car's manufacturer, or aftermarket parts, which are cheaper third-party copies. Without this specific coverage, most insurance policies will default to using aftermarket parts to save money. For a 10-year-old commuter car, that might be fine. But for a newer vehicle, or for someone who values the precise fit, finish, and quality of original parts, OEM coverage ensures your car is restored to its factory-fresh condition. These are the building blocks of a truly great policy. It's not just about being covered. It's about being covered in a way that truly protects your lifestyle and your finances. The top-rated companies will offer most, if not all, of these options, allowing you to pick and choose. Because a generic policy is like a one-size-fits-all t-shirt. It rarely fits anyone perfectly. And getting that perfect fit is how you unlock the final, and often biggest, layer of savings. This final layer isn't about one single discount. It's about a fundamental shift in how you view your relationship with your insurance company. We've been conditioned to believe that loyalty is a virtue that gets rewarded. In banking, you might get better rates. With airlines, you get status and upgrades. But in the world of car insurance, loyalty is often punished. It has a name: the loyalty tax. It's one of the industry's quietest, most profitable secrets. Here's how it works. You sign up with a great company at a fantastic introductory rate. The first year is great. The second year, your premium goes up by 3%. You think, okay, inflation, no big deal. The next year, it's another 4%. A minor accident in your state, even if you weren't involved, is blamed for a rate adjustment. The year after that, it's another small bump. Each increase is just small enough to not trigger your alarm bells. It's a pain to switch, right? You have to make calls, fill out forms, so you just pay it. You're a loyal customer after all. They must be giving you the best deal they can. But they're not. This slow, methodical increase is a strategy called price optimization. The company's algorithm has calculated the maximum they can raise your premium without you leaving. They are betting on your inertia. They are taxing your loyalty. Let me tell you about a friend of mine. We'll call him Mike. Mike was with the same big-name insurance company for 12 years. 12. He signed up right out of college. He was proud of it. He'd tell people, "Oh yeah, I've been with Blue Ribbon Insurance since I had my rusty old Civic." He saw their commercials during the Super Bowl and felt a sense of pride. That was his company. Every year his bill would come. It would be a little higher. He'd grumble, but he'd pay it. He had autopay set up. He never missed a payment. He had one minor fender bender in 12 years. By all accounts, he was the perfect customer. One day we were talking and I asked him out of curiosity what he was paying. He told me the number, and my jaw almost hit the floor. It was astronomical for his car and driving record. I told him, "Mike, you have to shop around. Right now." He was resistant. He felt like he would be cheating on his company. Sounds crazy, but that's the psychological hold this brand loyalty can have. Finally, he agreed. He spent 1 hour, just 60 minutes, on a Saturday morning getting quotes. The first quote he got, from a company with equally high ratings, was $450 less for the entire 6-month policy. That's $900 a year. The next quote was even better. He ended up switching and saving over $1,000 a year. For the exact same coverage. Sometimes even better coverage. He wasn't angry. He was furious. He felt foolish. He had paid an extra $10,000 over the last decade for absolutely nothing. He paid a $10,000 loyalty tax. Mike's story isn't unique. It happens to millions of Americans every single year. So how do you avoid this? How do you turn this system to your advantage? You adopt one simple, powerful habit: the annual insurance review. This is the master key that unlocks everything we've talked about. It ensures you always have the best coverage for the best price from the best company for you right now. Here's the 4-step playbook. Simple, and it will save you thousands. Step 1. Mark your calendar. Right now, go into your phone or your paper calendar. Find the date your current car insurance policy renews. Set a reminder for 30 days before that date. Title it, Shop for Car Insurance. Make it a recurring event every single year. Or every 6 months if you have a 6-month policy. This 30-day window gives you plenty of time to shop around without being rushed. Automating the reminder is half the battle. Step 2. The State of Your Union update. When that reminder goes off, your first job is to review your own life, not the insurance company's. Sit down with your current policy declaration page. Go through it line by line. Has anything changed in the last year? Did you get married? You could be eligible for a significant discount. Did you buy a home? Bundling home and auto is one of the biggest discounts there is. Did you change jobs and now you're working from home? Your annual mileage just plummeted. That's a huge rate change. Did your teenager finally get that B average? Good student discount? Did you pay off your car loan? You might consider dropping collision and comprehensive coverage if the car's value is low. Your life is not static, and your insurance policy shouldn't be either. You need to update your policy to reflect your current reality. Step 3. The competitive gauntlet. Now that you know exactly what you need, it's time to shop. Your goal is to get at least 3, preferably 5, competing quotes. Don't just go to one company. You want to create a competitive environment. Use an online comparison tool to get a baseline. They're fast and can give you a good snapshot of the market. But don't stop there. Then, personally call at least 2 highly rated major companies directly. Think of the ones we've discussed that have excellent J.D. Power ratings for claims and service. Finally, call one independent insurance agent. They can shop multiple smaller, regional companies on your behalf that you might have never heard of. You're attacking the market from 3 different angles. When you get these quotes, make sure you are comparing apples to apples. The exact same liability limits, the exact same deductibles, the exact same optional coverages. This is critical. You want to isolate the price variable. Step 4. The final play. You now have the ultimate leverage, information. You have a quote from your current company based on your updated life details. And you have several quotes from their top-rated competitors. You have 2 choices. If a new company blows your current one out of the water with a much better price and has stellar customer service ratings, the choice is simple. Switch. Thank your old company for their service and move on. It's not personal, it's business. Your business. But what if you like your current company? What if their price is just a little bit higher? Now you make the call. You phone your current insurer. You don't yell, you don't demand. You state the facts calmly and politely. You say something like this. Hi, my name is your name, and my policy number is number. My renewal is coming up, and I've been a loyal customer for 8 years. I did some shopping to make sure I'm getting the best rate, and I have a quote from competitor's name for the exact same coverage for price. I really like being with you guys and I'd prefer to stay. Is there anything you can do to match that price? The silence on the other end of the line is the sound of them checking your file. They see your loyalty. They see you've never missed a payment. But most importantly, they now know you are a retention risk. You are no longer the person who just pays the bill without looking. You are an informed consumer. 9 times out of 10, they will magically find a new discount you suddenly qualify for. They might not match the price exactly, but they will often come very, very close. And just like that, you have defeated the loyalty tax. This entire journey, from understanding liability to dissecting customer service, from checking financial stability to stacking discounts, it all culminates in this one yearly ritual. It's the process that puts you in the driver's seat, not the insurance company. Finding the right car insurance isn't about finding one perfect company and staying with them forever. It's about understanding that the best company for you today might not be the best company for you in 2 years. It's about having a system that ensures your protection, your family's financial security, is always placed in the hands of a company that is stable, fair, and competitively priced. You now have that system. You are now more informed than 99% of the drivers on the road. Don't just let this be interesting information. Turn it into action. Your homework is to find your policy renewal date and set that calendar reminder. That single 5-minute action could be the most profitable 5 minutes you spend all year. Protect yourself, save your money, and drive with true peace of mind.